Okay, students, I'm back, and this is video number 5 on chapter 12 on investments. And so we're down to impairment of available for sale investments. And impairment is very similar for available for sale investments to the way it's handled um, for held to maturity investments. Your book talks about that there. Notice my color coding here to try to help you see in the text what it's telling you. Um, Accounting for impairment depends on management's belief about whether it will sell the investment. If management either intends to sell the investment or believes it's more likely than not, that's more than 51% or more than 50%, that it will have to sell it before fair value recovers, the available for sale investment is written down to fair value, and the impairment loss, notice that, recognized in net income. So loss goes to net income, not to other comprehensive income. So if on the other hand, in green here, management does not intend to sell the investment or does not believe it is more likely than not, it will have to sell the investment before fair value recovers. Management is required, important word there, to estimate and recognize credit losses and reduce the carrying value of the available for sale investment with an allowance for credit losses, that's like bad debts, just as we do for the held to maturity investments. Now, that loss, that reduction there, that loss goes to net income, not to other comprehensive income for the credit loss. Any remaining impairment is accounted for normally as we recognize holding losses in other comprehensive income. So if you have a loss in an available for sale security, a decline in fair value, you have to determine whether it's a credit loss or just a temporary reduction in price, in value. Now, the credit loss, that goes to net income. The other decline in fair value goes to other comprehensive income. Okay, now let's move on down. How do available for sale securities appear in the financial statements? Well, in the income statement, the interest revenue is shown as net income, and right here they have sold the investment, and so they're recognizing a gain in the year of sale, but the gains from unrealized gains are recognized in other comprehensive income. So we see unrealized gain in 2021 here in other comprehensive income, and a gain for the current year of $10,057 in other comprehensive income. That was the unrealized gain up until the sale. But then when the sale occurs, the total gain shows up in net income in the year of the sale. So that 53,703 is the sum of these two numbers. Okay, and then the reclassification adjustment closes out this gain that's been shown in other comprehensive income. So we're reducing other comprehensive income here for the total amount of the gain, which gets reported now in net income. Okay, on the balance sheet, we see the investment and available for sale bonds listed there in the asset section. Usually available for sale securities are considered non-current, but they could be considered current. It depends on management's intention. And in the shareholders equity section, we see the accumulated other comprehensive income. So statement of cash flows, receipt of interest shows up in the operating activities, and purchase or sale of the securities shows up in the investing activities. Okay. This table right here you will find really helpful, and it just walks you through not only how things are treated, but what the journal entries are as well. So we see here for held to maturity investments that, excuse me, well, let me go the other way. When we purchase bonds, doesn't matter which method we use, the entry is always the same. When we record interest revenue, the entry is always the same. We debit cash, we debit the discount or credit the premium for its amortization, and then we recognize interest revenue based on the amount of cash received and the amount of amortization of discount or premium. Now, adjustment to fair value, we don't do that with held to maturity securities. With trading securities, the gain or loss goes to net income. And for available for sale securities, we recognize them at fair value, but the gain or loss goes to other comprehensive income. Okay, when we sell them, the first we make the adjustment to adjust the investment to fair value for trading and available for sale securities. Again, in trading securities, that goes to net income. For available for sale, it goes first to other comprehensive income. Then we have to reclassify the total gain out of other comprehensive income or accumulated other comprehensive income. And so we remove the fair value adjustment that we recorded here and here, and debit the reclassification account. Now this is going to be closed out to accumulated other comprehensive income, and thus pull this amount out of accumulated other comprehensive income. Then notice down here in trading securities, there's no recognition of gain or loss at the time of sale, because the gain has been fully recognized in net income from these entries here. This one bringing the recognition of the gain or loss all the way up to the point of sale. So all we're doing, debiting cash, removing the accounts associated with the investment. So we're removing the discount associated with the investment, removing the investment, and also removing the fair value adjustment. All three of these are necessary to record the investment at fair value. Okay, under held to maturity securities, we debit cash, remove the investment accounts, discount and the investments, and then recognize any gain or loss. On available for sale, we're debiting cash for the cash received, removing the discount and the investment, and all of the unrealized gain or loss has now been eliminated, and so we're now recognizing the gain into net income because it has now been realized. We've now received cash. Okay, let's move on down. All right. Under IFRS, there's really not that many differences. The main differences are in terminology. So transfers between reporting categories. Right down here they explain that. The real key thing to remember here is reclassifications are quite unusual. They don't happen very often. When they do, disclosure notes should describe the circumstances that resulted in the transfers. Up here, transfers between reporting categories, you report those at fair value, and then you adjust and just start using the new method, basically. So nothing really complicated there. The fair value option. We saw at the beginning of the chapter, you have the right to choose the fair value option for held to maturity and available for sale investments. That means accounting for them as you would for trading securities. So at fair value, with any changes in fair value being recorded into net income. Now, down here, it's really important that you understand this. Company decides whether to elect the fair value option on the date the company purchases the investment. Now, individual investments, you make that the declaration or that decision individually for each investment. That election is a one-time election and it is irrevocable. So you make that decision for each investment at the time you buy it, and then you're stuck with whatever decision you make forever, basically, for that investment. Okay, let's look at brief exercise 7-6 or 12-6, excuse me. And oops, there's moved down to 12-6. I should have done this earlier. Sorry about that. But there it is, and let's bring up the problem. And whoops, wrong one. Okay. Here we go. This is similar to, actually it's not. S&L Financial buys and sells securities that it typically classifies as available for sale. Yes, it is. It's similar to these up here with Coca-Cola. On December 27th, 2021, S&L purchased Coca-Cola bonds at a price of $875,000, sold the bonds on January 3rd, 2022 for $880,000. At December 31, the bonds had a fair value of $873,000. When it purchased the Coca-Cola stock, S&L Financial decided to elect the fair value option for this investment. What pre-tax amounts did S&L include in its 2021 and 2022 net income as a result of this investment, ignoring interest? Okay, this goes back to the same way it was handled when, which one was it, where they treated it as available for sale. Anyway, one of them. But unimportant. The real key is we recognize the gain or loss in each period into net income. So December 31, the value had declined by $2,000. So we're going to show a $2,000 loss in net income for 2021. And then in 2022, January 3rd, it had increased from the December 31 valuation by $7,000. So we're going to show a $7,000 gain in that year. So there we have it, the $2,000 loss in 2021 and the $7,000 gain in 2022. All right, that concludes this video. So we will pick up in just a few minutes.